Season 2, Episode 13 of A View from the Left Side focuses on the nationwide push to create a national infrastructure bank in the United States. This is a great idea as far as I'm concerned. There is a bill in Congress that is H.R. 3339. It is looking for supporters in Congress right now. And so my three guests for this podcast today are going to talk about the importance of creation of a national infrastructure bank and how that will help jumpstart our economy in a post-COVID world. The United States has actually created infrastructure banks 4 times in our history in order to create massive amounts of infrastructure in a short period of time. Basically, what they're doing is creating jobs and improving the infrastructure in order to build the economy. There have been proposals in the Congress about Build Back Better and different sorts of infrastructure packages, but the infrastructure bank would be $5 trillion in capitalization. This would be enough to do all of our projects, not just some of our projects. This has worked in the past. Alexander Hamilton had a national bank in order to create infrastructure for the colonies, in order to make the colonies from colonies to the United States of America. And he built an enormous amount of roads and bridges with that national bank. Fast forward to the more modern era where Herbert Hoover created the Reconstruction Finance Corporation and was taken up by Franklin Roosevelt when he became president, and he ran with it. The Reconstruction Finance Corporation rebuilt the United States after the Depression. My guest today will tell us how this National Infrastructure Bank will help us rebuild our failing infrastructure in the United States. It is woefully underfunded. We are going to lose global economic standing if we don't get this together. And so I think it's a great idea. I think it's a very good way to do this, to use a public banking model in order to build infrastructure and to spark growth and a sustainable economy. My guests today are Alphecca Muttardy, who is a professional macroeconomist. She is a former senior economist with the International Monetary Fund, where she worked for 25 years. She is on the board of the Coalition for a National Infrastructure Bank. Also with me is Ellen Brown, who is the founder and chair of the Public Banking Institute. She is the author of 13 books, including Web of Debt. And if you have not read Web of Debt, do it. That book changed my life. It's an excellent book talking about debt and the history of the United States. She has a podcast called It's Your Money. Lastly, we have Professor Robert Hockett, who is an Edward Cornell Professor of Law and Finance at Cornell University School of Law. He is on the board of the Public Banking Institute, and he regularly advises federal and state legislators on monetary and financial initiatives. He has previously worked at the Federal Reserve Bank of New York and the International Monetary Fund. Obviously, I have very well-versed guests today, and it's going to be a wild ride. Looking for a little bit about Arizona water policy and international finance and inflation. We cover a lot of topics. Well, thank you all for joining me today on my podcast, A View from the Left Side. I think the National Infrastructure Bank proposal is very exciting. I've been interested in public banking for a very long time, and I want to know more about H.R. 3339 and how this could help the United States and help our economy. So, Alphecca, we're going to go with you first to give us a little bit of background about what it is and how it can help us and how it be capitalized and the future in the United States with a National Infrastructure Bank.
Great, and thank you very much for having me, and it's lovely to be with your audience today. I'm a macroeconomist, so I would like to explain this bank from the point of view of financing, adequate financing, and why we need a bank like this, especially in today's economic circumstances. So our bill in Congress, H.R. 3339, what does it do? It creates a public bank to lend for infrastructure projects all across the country. And the first thing that you need to know about it is that it's big enough to cover all of our infrastructure needs. We're the only one that I know of, other than the American Society of Civil Engineers, who sat down and said how much money has been coming in and what is the funding gap that's not being covered. Our bank will cover all of that funding gap identified by the engineers. In addition, we'll cover a few other things like affordable housing, a complete high-speed rail network all across the country, and large-scale water projects to address drought in the southwestern states where half of our nation's food supply is grown. So these are the kinds of things that the bank will cover. And is this a new idea? Is this something that's not tested or true? No, actually, we've done this 4 times before in our nation's past. We have had 4 large infrastructure banks starting after the American Revolutionary War. This was put together by Treasury Secretary Alexander Hamilton and President George Washington. We had another one under John Quincy Adams, a 3rd set of banks under Abraham Lincoln, and a 4th really large institution called the Reconstruction Finance Corporation. Everybody knows what FDR did to get us out of the Great Depression and win World War II, but they don't know the critical role that this institution played in backstopping and being the financing of last resort to get us out of that depression and win the war. So this bank, this 5th proposal, is modeled on the earlier 4. And one reason that it works is we're not going to the federal budget to ask for money to get the bank started or to sustain its operations. Even though it's publicly owned, it's self-sustaining. We instead use the Hamilton model, go to the private sector who are holding treasuries for long-term savings or investment purposes, and ask would they like to sell in some of their treasuries into the NIB and an exact swap change for preferred stock in the NIB. And the preferred stock would pay these investors a little extra. That's the enticement for them to sell in. And the extra stream of money would come out of the interest earnings from the NIB's loans with plenty of money left over to meet the bank's other operational needs. So it's self-sustaining. And so that means we're able to cover everything without, get it, no new taxes, no new debt, no new deficit spending is needed to make this bank roll. And then the bank goes out to give out loans exactly like a commercial bank does. Once it's capitalized, it gives out loans exactly like a commercial bank, uses the same kind of accounting software and everything. And actually, each time it books a loan, it creates a deposit on the other side of its books. Whenever you create a deposit, you're actually creating money. That increases our money supply. 90% of America's money supply is created by banks like this whenever they book a loan. And then it uses cash on hand coming in from other deposits or loan repayments to move money out of this deposit that is cash checks against it and get that money flowing into the rest of the banking system. So the loan terms are very advantageous. This is a public bank. We want to keep financing costs down. And so we'll be charging around the Treasury bond rate for interest charged, flexible repayment terms, can pay out of either user fees or this is really going to enhance economic growth, get it way up there like it was the last time we had a bank, much higher than it's been lately. Why? Because these kinds of investments are so productive for the economy. Every dollar that you put in, borrow and put in and create money supply for puts back $3 to $7 back into the economy. We're producing more. Buy America only for the construction inputs means we'll be promoting American manufacturing. The jobs will be great paying jobs, millions and millions of new great paying jobs, which will put more money into people's pockets. They'll go out and spend things. This will all have a multiplier effect on the economy and grow the economy and bring in new tax receipts for state and local governments to repay loans. By the way, they will be the main borrowers from the NIB for their infrastructure projects. They can come in directly. So if they're a local city or county, these jurisdictions own most of our roads and bridges, but they don't get the money supply from the federal government to fix them. It doesn't reach them. We'll lend to them anyway and promote their economies, get their workers in their area into these better paying jobs. They'll have much more tax receipts coming in. And altogether, this will not only build infrastructure, it'll supercharge the American economy, help with income redistribution, great for businesses. Why? Businesses need infrastructure. They need to move their trucks and they need to move their goods. They need to have competent broadband supplies in their neighborhood to promote their growth. They need to improve supply chains, which are really hindering their business right now. All those things will be improved by the bank. In the Arizona area, in the Southwest area, one area of emphasis is that we want to really work on bringing in new water supplies into these areas where farmers and ranchers are really hurting right now. They're selling off herds. Their livestock is dying. They're plowing under fields because they haven't got enough water to water them. This will affect food supplies all across the nation and really jack up food prices even higher than they are already. It's a matter of survival and economic survival in those areas, and we want to help with new water resources, and we also want to help with affordable housing. Because we've had inflation now, it was bad even before COVID, but because we've had inflation now, some cities' rental prices have gone up by as much as 30%. People are becoming much more housing insecure because they're facing higher inflation. So in all these aspects, this National Infrastructure Bank is, we think, the only policy option to dig us out of this hole that we're in right now.
I want to get back to the water issue, but at first I'd like to ask you a little bit about the significance of what Roosevelt did, particularly about the Rural Electrification Administration. Many years ago, I used to work for the Arizona Electric Power Cooperative, and so I know about the REA. I worked in PR back then and wrote a lot about it. And so when you look at how that changed the lives of people in rural America when they got electricity, broadband is the same thing. Broadband and high-speed rail, that would help rural America so much because, right now in Arizona, we've got a big state, we sit there in Maricopa County and Phoenix and the least sustainable city in the country. And we talk about rural Arizona running out of water and they don't have broadband. Everybody just kind of like shrugs it off. I mean, maybe we'll do a little bit, but this would help them tremendously. So I was wondering if you could speak to that, or Ellen Brown, if you want to speak to that idea about how the infrastructure will have so many offshoots in lots of different types of businesses.
So one objective of this bank is to make sure that these resources get into every single nook and cranny of the United States, places where they're not reaching right now. So we can do a direct project loan to for example, a Native American nation or a local community to open up their own water facilities or open up their own municipal broadband and make sure that we get projects out, even if they're not economically viable right now. And why do we say so? Because the example of the RFC, when it lent to rural America, when 90% of rural America was not electrified, everybody said to Roosevelt, oh, they'll never be able to pay those loans back. They paid them all back. They not only paid them back, but they bought electrical equipment on loans that were put into their electric bill so that they could run, pumps and things like that for their farms. And that made their farms much more productive. And the analogy to broadband and clean water is exactly the same. It's a disgrace that we have houses in America with no running water. Compare that to the Chinese, who are not only using banks like this to build a high-speed rail network to connect their country and other countries, but they're building a complete water grid across the whole country. They increase supplies by 20%. They do conservation at the same time that newest technologies to irrigate and produce food. They put it into a whole big holistic plan. And that's what we need to do. Under RFC, we did projects like that where we built the Hoover Dam, the Grand Coulee Dam, did projects along the Colorado River, which is running dry right now, and it services 40 million Americans. This is catastrophic. We can't keep watching the water level going down and down and down and doing nothing other than cutting off water supplies to farmers. We need a better plan. This National Infrastructure Bank will do that.
Well, yes, in the state of Arizona, actually in June, the end of June, we did pass a $1.4 billion water initiative, but it's all based on public-private partnerships. $750 million of it will be doled out into multiple projects, most of it for augmentation of water to get water from the Sea of Cortez or the Mississippi River. We have no plans. We just got money, and it's about financing. So this is somewhat different because I see it as a different way of doing things than the public-private partnership. Isn't that correct?
Yes. We know that many financing bills around for infrastructure do require public-private partnerships, but we want to keep public infrastructure in public hands. But water is a public good. And we've seen adverse consequences of these P3 projects. For example, in some places in Pennsylvania where they privatized water, even though there was a contract stipulation not to raise rates right away, as soon as that stipulation passed away, they raised the rates by 30%. I hope that Arizona doesn't become surprised at some point later down the road at what their water bills are looking like. But water bills are going up and people have lost their homes over them. It's a very serious issue. We think water should be a public good, and if we can keep it in municipal hands, that's our first preference.
The difference with a public-private partnership, of course, they want profits. And so this bank is basically a bank at cost. Nobody makes profits except that the people who do the swaps. They get 2% on their securities, but that's 2% divided by 10 if you consider that you're leveraging that money at 10 to 1. So it's 0.2% that you have to pay as the actual profit, monetary profit, and the rest is all just covering your costs, including the cost of workers, of course, and materials. So it will be much lower. I can remember, I'm not sure what public-private partnership, what they're expecting now, but I remember looking at it once and it was like 12% that they wanted for profits.
Yes, it's pretty high. I was going to ask a little bit more about who could buy into this. Somebody who has treasury bonds. So is that like a really very rich person? Is that a mutual fund? Is it a corporation? Is it somebody who has a retirement and says, oh, I have some treasury bonds, I want to put some money in? Because I know that when I did public banking talks, people were so enthusiastic about it. They said, I would put some money in there and let it be invested. So who can invest in this? Who can put their money in to help it be capitalized?
So there's two ways to do it. One is to do it on the capitalization side, and that is to swap in your treasuries that you're holding. So who's holding treasuries? There's 20 trillion out there. We need altogether only about 500 billion to capitalize 1 to 10. Holders currently are foreign governments. That's how they keep their reserves in dollars, and so they buy treasuries to get a little earnings off of it. It could be a corporation through its savings account. It could be even a state and local government that has a rainy day fund where it keeps it in treasuries, or its pension funds for its workers. And we would always love, if state and local governments are coming in to borrow from us, they can also be an investor and earn a little bit extra on their investment through the capitalization side. A second way that anybody can also support the bank is to put their deposits in it. It'll be an electronic bank, nationwide. The deposits will be offering a little bit extra above and beyond what normal banks offer because we need to attract deposits. One way is to bank with an infrastructure bank and promote projects. And then a third way is to bring to the attention of local area legislators, oh my gosh, all these things in my neighborhood need fixing. My kid's school bus is going across this bridge and I'm really worried about it. And it's been sitting on your wait list for the last 15 years. Why don't you go and take a loan from the National Infrastructure Bank and get this thing fixed right away?
And I don't think you mentioned individuals holding securities. I mean, people do have bonds.
Sure. Yeah, people own T-bills, right. Everybody keeps their T-bills in an electronic brokerage house type bank institution. And it's just a matter of swapping out of one account and into another to do this transaction.
So I was wondering if you could comment on the United States infrastructure investment compared to some of our competitors. We have been letting roads and bridges crumble. We've been allowing school children to attend schools where the pipes have lead in them, and we do nothing about these known problems. And so how do we compare to other countries as far as investment in infrastructure? You mentioned China, but I'd like to learn more about that.
This is called the American system. We invented this system of having a public bank to extend credit to build infrastructure. We don't do it anymore, but other countries have picked up, and that's their model. So Europe, for example, has an international infrastructure bank that lends for projects, and they invest about 4% of GDP on infrastructure. The Chinese have 3 such banks and invest about 8% of GDP, and we're down at 2.4% of GDP because we don't have a bank like this. It's absolutely essential to revive our economy. We've offshored so much manufacturing. We need to bring it back onshore. We've gutted our working class. We have huge income inequality. It's not enough to try and tax it away. We need to put more money in people's pockets to earn a sustainable living through building out new infrastructure. And all of this can be done. And we can also lend against any inflation and recession that might come along. And this bank will be a solution for that as well. So altogether, we need to revive what we know has worked in the United States and we see it working abroad as well.
Yes, when I started Googling National Infrastructure Bank, it was popping up in all these different countries. I was like, whoa, lots of people are doing this. It seems ridiculously out of whack that we would have so much need to have all this crumbling infrastructure. Obviously, people talk about it and to just ignore it. It's putting us at a global disadvantage. This idea that you have with HR 3339, I think it's a great idea because it will help us do a reset. We had Hamilton doing a reset after the Revolutionary War. We had Lincoln doing a reset after the Civil War. We had Roosevelt dealing with the Depression, and we've had COVID. We've had a lot of spending go out of the government. We have all sorts of what I would see as global economic catastrophes that could happen at any time, especially with recession and war. And so this is something I really think that the United States needs to do because this is a time of crisis, and I think that this would help us move forward. So how would the current plans to dig us out of our current economic situation, how would those plans today be different from what we would do with an infrastructure bank?
Yeah, that's just a really great question. I think the problem with what we're doing at the moment is we rely too much on private sector initiative. And for many purposes, that's fine. But I note that all of the difficulties that you just listed are what you would call sort of public good related problems. In other words, the solutions to those problems are public good. And public goods of that kind are by definition the kinds of goods that it's just not even individually rational for the private sector to prioritize, right? In other words, if the motive that's driving you is primarily a profit motive, and especially if it's a profit maximization motive, then it's very often just not in your interest as a private actor to undertake to solve those problems. It's just not your role. So insofar as we're talking about public problems rather than private problems, we really require public institutions that are not actuated or activated by private profit maximization motives in doing what they do. And in effect, the NIB, like its predecessors, the RFC, founded by Hoover and then expanded by Roosevelt, and of course the Hamiltonian institutions, those were all public institutions for a reason. It wasn't because the founders or because Herbert Hoover of all people or Franklin Roosevelt of all people didn't appreciate the need for a private sector or didn't understand the virtues that are sort of offered by a robust private sector economy. It was just that they understood the difference between public goods and private goods, and hence the difference in the needs between public institutions and private institutions.
The economists always cite Milton Friedman that inflation is always and everywhere a monetary phenomenon. So they emphasize the monetary part, but the rest of that that premise is too much money chasing too few goods, and they never look at the other half of the equation, which is too few goods. Or you can see there's three parts of the equation if you count the chasing part, which is the velocity of money. We did pour money in 2020 when, there were all the relief payments and the Fed did, what was it, $2 trillion for the banks, or maybe it was more. But anyway, we did have all this money going out at that time. But the money that went to the banks is mostly just sitting on the banks. It's not being spent. So it's not into velocity. It's not out there circulating. Money went to big corporations. And the first money, of course, went to BlackRock, which was in charge of doling out the money. So they made sure that their ETFs got funded. And the money that went in people's pockets is long gone. I mean, it was like $3,200. How far does that go over the space of 3 years? And people were out spending when the lockdowns lifted because they'd been cooped up and they went out and started traveling and going to restaurants and all those things they hadn't done, sort of making up for lost time. But that was a year ago. And people have spent to stock up on groceries and things because they're worried. The president says, be prepared for food shortages. So people are stocking up, they're getting prepared, but they actually have less money to spend right now than before COVID on average overall, poor people particularly. So there's not a lot of demand competing for the goods that are out there. The problem is shortages. There's not enough goods out there. So how do you get more goods? One obvious is agriculture, food. So you need to do all those things that have been mentioned, the water and, keep the farmers in business. That's what they did in the 1930s. The Reconstruction Finance Corporation made loans to farms, and not just big loans like for electricity, like for dams or whatever, but they made loans for small businesses and farms, anything that could pay back that was constructive. And that is the American system model. And that's exactly what the Chinese are doing. They have 3 policy banks. They're called policy banks because they're limited to government policies. I mean, you might say, well, that's not the American way, that's too socialist or something. But that was the Hamiltonian way. That's what he said, was that this bank was to be for infrastructure and manufacturing, development of the economy. And the second U.S. bank particularly did a lot of infrastructure, and Lincoln's greenbacks did infrastructure, and obviously Reconstruction Finance Corporation did. So we've done it before. We just need to, I think our biggest problem is political. People just can't agree, and people don't realize, they think $6 trillion, that's going to be $6 trillion in taxes. We can't afford it. They just don't understand that, no, you don't have to take this money before you spend it. You can spend it first. That's the way banking works. You spend the money, and it's created in the process of lending or spending. Of course, it doesn't get lent unless it's going to get spent. I mean, people don't borrow unless they have something to spend it on. And then if it goes into financialization or whatever, obviously it will be inflationary because you're talking about money making money. But if it's limited to going into productive purposes, things that do pay back, then you've got a sustainable system. That's what the Philadelphia colonists figured out, that they, in order to avoid inflation of printing and printing and printing, they formed a bank. The money went to the farmers, and the farmers paid it back. And it was a sustainable system, and the economy took off. It became the strongest economy among the colonies. So we can do that again. It's just a matter of political will. I think we've got to get it together to do it.
You can call them a policy bank, but what they're doing is they're directing investment in the most productive place. I mean, when we had relief from the budget for the COVID downturn, it mostly went into consumption spending. This is forcing investment into productive investments that raise the productivity of our economy. Our trucks move faster. We're able to produce more with the same number of inputs. That lowers the cost of things. And investment income is always the best kind that you can do. And we need to have it's not something you can do on this 5-year budget plan. You need a long-term infrastructure plan and a long-term source of sustainable funding to make this work. So it's both planning and financing at the same time. And it is absolutely the case that we use this successfully. We on one of our tapes on our website, nidcoalition.com, you can see a tape of Robert Kennedy talking about the Tennessee Valley Authority. And those people were Republican, Democrat, whatever, but by Depression standards, they were some of the poorest in the country. We tamed the river, we built industry around it, we improved the livelihood of all of those people in the region. All 7 states benefited from this, and we grew the economy in that local area. And it can be done across states over and over again. The picture works in the United States, and we need to revive it today for our economy.
What do you guys think we should cover that we haven't covered yet?
The 2 objections that I always hear, one is we can't afford it, because people don't understand how it's funded. And the other is, it's just going to be another boondoggle for the politicians. How do we keep corruption out of it? How do we make it democratic and fair, and so that every state gets the appropriate amount for their state, and it doesn't get corrupted into the pet projects of the politicians? And that's a question for Alphecca.
Okay. Well, I can pick that one up. First of all, our bank is big enough to cover everybody's projects. So there's not this competition between centers and departments of transportation and big cities and rural areas, because there's enough in there for everybody's infrastructure. That's the important thing. The second way that we oversee projects is the borrower that comes in for the project is the borrower the county or the city official who can oversee his project. He will assign a project manager to design this project and roll it out. But then the National Infrastructure Bank will also have a back office engineering section to help develop these projects, because a lot of these local areas have lost their expertise to handle. They had to let people go, over different business cycles, and they had to let people go, and they lost the ability. So we can help them with the best, latest technologies to build out new clean water systems, coordinate road work with utility work so that we're saving on costs, get our transportation systems linked up with these new housing projects that we're going to build to put people into affordable housing so they can get to work easily. All these things can be done and aided by the bank. And then in addition, we have lots of banking overlays of security to make sure that the projects stay bona fide. We use the example of the Reconstruction Finance Corporation, which had built really complicated projects like the TVA, but had zero instances of corruption or projects going bad. That includes loan officers to check up on loans, the engineers, as I said, to help. All project loans that are given out would be transparent and recorded for the public to see, so the public could also be an inspector sort of general, and it has its own inspector general, reports to Congress on the operations of the bank. So multiple layers to make sure that the projects get rolled out well.
I think the transparency and the oversight are very important. The water initiative that Arizona passed in June, just a few weeks ago, it's all managed by a group of 9 people that are primarily controlled by the Republicans and by Governor Ducey. And it's all P3, as I said earlier. It's just going to be crony capitalism, and our water is going to get more expensive. Anyway, so with these projects, who's going to own the infrastructure once it's built? Like, for example, if the NIB lends money to the state of Arizona to build the desalination plant from the Sea of Cortez to Arizona, who would own it under your plan?
I think Alphecca will have probably a more thorough answer than I can offer, because mine will be more schematic, and I think Alphecca's might be more detailed, and Ellen's might be as well. But I think in general, it just depends on the particular project, right? I mean, if you look at the New Deal and the Second World War mobilizations as sort of case studies, we find immediately that some of the new facilities or new infrastructures or new capacities that were built were retained by the public sector as publicly owned things. Other things were built with public support, but as privately owned entities or institutions from the get-go. And some, of course, started one way and then moved the other, right? So you had public institutions established or public entities created by the public sector during, for example, the Second World War mobilization, and they were kept under public ownership during the duration of the war, but then were spun off and sold cheaply to the private sector once the war was done, and the need for the public sector to kind of retain ownership was not quite as urgent any longer. So my guess is that something like that would happen now too. Different projects would have different ownership structures. But again, as I said, Alphecca would be able to give more detail there, and I suspect Ellen would too.
We imagine that this bank is lending to public entities for public infrastructure that they own, a county for its roads or bridges or for its schools or something like that. So 90% of the projects the bank finances will be those publicly owned projects, and we want to keep them in public hands because that's in the public interest to do so, as Professor Hockett said. But there may be instances where we have bottlenecks, and so there is a clause in our bank, which I affectionately call the bottleneck clause, where if there's some kind of impediment that the private sector is not meeting or bringing forth supplies that are needed, then the public bank, the NIB, can step in and make a loan to the private sector for those kinds of activities. For example, right now, construction has been on a real boom coming out of COVID, and construction costs for cement and steel and copper and those kinds of things are really highly elevated. And we're still importing a lot of these things, PVC pipe and things like that, where we should be making it here in America. The Buy America Only provision of the bank will help, but if we need to bring those costs down quickly and get more supplies in and open up these supply chain problems, then the NIB can lend into these kinds of activities as well. The main thrust, however, will be to make sure we get all of our public infrastructure investments financed.
One of the things that is a big struggle for the state of Arizona and many other states is affordable housing and homelessness. And so I'd like to learn a little bit more about what the bank could do to help us with the construction, I guess, that needs to be done in order to get more affordable housing. Right here in Arizona, we're incentivizing luxury apartments like crazy. And, during my time in Phoenix in the last 6 months, I had to rent a tiny 500 square foot apartment for $1,500 plus the utilities and all kinds of other expensive. And so I don't even see how renters are making it in the U.S. these days. There are landlord-tenant laws that do not favor the tenants, at least in Arizona. And so I'd like to learn more about how this fits in with affordable housing and how that would work.
The area of sort of home finance is an area that I've spent a fair bit of my sort of scholarly life researching and writing about, particularly around 15 to 10 years ago when an eminent domain plan that I put together to deal with the underwater mortgage problem after the last crash began to sort of spread and get talked about all over the country. So as I see it, there's a kind of a counteractive and a proactive set of measures that have to be taken. To start with the counteractive side, it's really critical, I think, for us to recognize that a huge part of the problem right now is the further encroachment of Wall Street type institutions into a realm from which they used to be prohibited and into a realm that used to be entirely publicly handled, right? So what people sort of forget or maybe never knew about was before the Roosevelt years, fewer than a third of American households owned their own homes. And this was partly because there was no secondary market in home mortgages. It was also partly because basically housing markets and real estate markets were fragmented on a sort of state by state or even oftentimes a locality by locality basis. And so the prevailing mortgage instrument was one where you had to put down 50% of the value of the home to buy, and you could only borrow for up to 5 years, meaning you had to kind of roll over your loan every 5 years. That was a pretty difficult set of financial circumstances for most Americans to deal with, and that's why the homeownership rates were so low. So when the crash happened in 1929 and then the Depression ensued, one of the first things both that the Hoover administration in its final years recognized and that the Roosevelt administration then recognized right from the get-go was that the housing markets were a critical part of the U.S. economy. We had to sort of shore those up and maybe even improve them as part of the project of revitalizing the economy. Something like 1 in every 10 jobs had something to do with the home building, with the real estate sector. So the two brilliant things that they did, first of all, was to establish a system of mortgage insurance. Basically, they created the Federal Housing Administration, or the FHA, specifically to offer mortgage default insurance to banks in order to take the risk away from banks. And the strings that they attached that the loans had to have certain characteristics. Notably, they had to be 30-year fixed-rate mortgages, meaning they would be predictable and sort of slowly paid down instruments that typical Americans could afford and hence wouldn't default on. And of course, there were housing quality standards as well. Then subsequent to that, they established a secondary market-making institution that we still have with us to this day. That was Fannie Mae, which was a public institution whose job was essentially to buy mortgage loans off of the books of banks that didn't want to keep holding them, in effect offering liquidity then, which had previously not been available, right? So that brought down the cost of lending, it brought up the quality of homes, and essentially within a very short period of time, we had a situation where well over 2/3 of American households owned their own homes. And this was all through public institutions. The private sector had nothing to do with it apart from the original loans that were extended by the banks. But even that was public in effect because they were publicly insured and had to be quote unquote conforming in order to do that. Over the course of the 1990s, we basically privatized all of that stuff in various ways. And we made Fannie Mae more shareholder controlled than it had ever been. And we let Wall Street investment institutions get into the act. That's what brought us the bubble and the bust and the crash. The thing that we stopped, and most people kind of know at least a little bit about that because most of us are old enough to remember that 2008 nightmare period. But what seems to have gone unnoticed by many is that Wall Street didn't just sort of get out of this area once the crash occurred. It's just a new set of Wall Street institutions stayed in and moved in, and they took on a new role. They started buying up the foreclosed properties that people were turned out of, that former owners had been turned out of after the 2008 crash, and then started renting them back. And ironically, in many cases, they were renting them back to the people who used to own them. It was unbelievable. It was disgustingly ironic. And so now all of a sudden institutions, private equity firms and hedge funds became the world's largest absentee landlords for lots of people. A lot of the housing price problem that we're seeing right now is driven by precisely this. These institutions not only, of course, are slumlords as landlords when they're renting properties, but they're also buying up huge swathes of real estate stock and then holding it off market in order to drive prices up. We used to have a word for this in the 19th century. It was called market cornering. It's just that those who cornered the markets were cornering the silver market or some commodities market or other. And we don't seem to have a vocabulary now for the idea of cornering a housing market, but that's what's happening. So the first counteractive measure that I think we have to take is we have to boot all of these Wall Street firms out of this whole realm. This should just not be open to Wall Street speculative and predatory institutions. They should simply be flatly banned from involvement in these markets altogether. And that itself, I think, would eliminate a lot of the perceived shortages because, again, insofar as the shortages are a product of market cornering, where stuff is being bought and then held off the market, these are artificially induced shortages rather than natural shortages. The second item that I would suggest, which I can be quicker about, the more sort of proactive and counteractive measure, is if it is indeed the case that there is simply physically not enough housing stock in existence in certain markets, something like the NIB can assist in rectifying that situation too. And again, here we would be following a precedent that we can kind of look readily to in the Second World War period. In addition to the Defense Plant Corporation and the Defense Small Plant Corporation and other firms that the RFC was financing to ramp up the production of war material, there was a Defense Homes Corporation that was established during the Roosevelt years because it was understood that if large numbers of people are going to be moving to new cities or new areas where new factories are being built to produce for the war, these people are going to have to live somewhere. So the Defense Homes Corporation built entire neighborhoods. Long before there was Levittown, there was the Defense Homes Corporation that was building entire neighborhoods and routing power and gas and water to these neighborhoods and building schools for the kids of these workers and building health clinics and the like. We can do that same kind of thing through the NIB now in any areas where there are actual physical shortages of housing rather than sort of artificially induced shortages, sort of caused or brought to you by the wonderful folk in the private equity industry that are holding them off market.
And I would add on to that one thing that the National Infrastructure Bank will do at the start, that's what we've priced into our bank, is we're going to focus on a segment of the market that is not being helped at all. And that is the lower income earners who are earning less than 30% of the average median income in their area, and they're woefully housing insecure. They're paying more than 50% of their household income on housing. Now that inflation is high and food prices are high, they haven't got 2 cents to rub together for anything, to buy their medicine, to pay for their food or anything. There are some nice maps of where these areas are. They are typically in red-lined, poorer areas that have never seen investment going in there. We want to fix the infrastructure in there. We want to fix the pipes in there, the roads in there. We want to train those workers to build this 21st century infrastructure technology that will boost their income so they'll be able to better afford affordable housing and provide the number of units of affordable housing just for them that are needed. So that's the niche that the bank will work on.
So, Bob, that was really interesting. I mean, I totally agree. We have to get rid of Blackstone and BlackRock. But how do you do that? I mean, antitrust, could we prevail in an antitrust suit? Maybe?
I think there are a couple of ways, Ellen, and in fact, there's legislation that I've recently drafted that might be proposed in the coming weeks by certain members of Congress. So I'm sort of reporting on something that might actually become real law. But it seems to me there are two ways to do it, and you can choose either or both. One would be simply to put in place a prohibition. Basically, all institutions that are regulatable by one or another member of the FSOC, or one or another of the financial regulators, you might simply say you're not permitted into these markets any more than during the Glass-Steagall age. Banks, commercial banks, were permitted to engage in investment banking type activities. Another way to do it would be to say, okay, we're simply going to tax any such holdings that any financial institutions of any kind are owning, and we're going to tax them at a rate that renders it no longer profitable for them to be engaged in this business. So we'll sort of drive them out, in effect, by taxing them out. And I don't have any apologies to offer for that. I think there are certain realms of human life that simply should not be subject to the profit motive at all, let alone speculative predatory motives of the Wall Street kind. And that includes, it seems to me, healthcare and housing, especially, and education, actually. So let's say housing, healthcare, and education just should not be subject to the profit motive, and certainly not to speculative or predatory motives. And I'm perfectly fine with simply prohibiting it or banning it or taxing it to the point where it's just not worth the while of these sorts of predatory institutions to get into. And again, this is not a particularly, somebody might say, well, that sounds like socialism or communism or whatever, but it's so. Well, then America is one of the world's most interesting exemplars of past forms of socialism, because we used to have these kinds of prohibitions in place without apology. Again, in certain realms, at least. If these institutions want to gamble on other things like cryptocurrencies or whatever, go ahead, have at it. But you don't get to lever up, and you don't get to subject the entire financial industry or financial system to risk, and you don't get to keep people from being able to live, either because they don't have homes, or because they don't have access to affordable medicine or drugs, or because they can't get themselves educated. That's just not a realm that should be subject to these kinds of risks or these forms of predation.
I think that we're going to have to wrap up here, but I want to give you all a chance to give me some parting thoughts on things that you want my listeners to know about creation of a national infrastructure bank. So we started with you, Alphecca, so I'll go to you for parting thoughts.
This kind of national infrastructure bank is successful, proven, been done 4 times before. It's sustainable, it's passable. And by the way, your listeners can really participate in this. Because the politicians are a little bit slow in the uptake, we're educating them about our history and our past. We're using a grassroots effort and communications exactly like this podcast to let people know that they can call their members of Congress and tell them to vote and push for this bill, H.R. 3339. And you can help to make it happen. Go on to nibcoalition.com to get more information.
I know that we talked about this earlier, but it seems like it's a helpful closer as well. Just for anybody who's not familiar with this kind of institution and who thinks that this is somehow some exotic new invention that we're sort of trying to fob onto America, I just want to reemphasize the sense in which this is a great American tradition, a tradition that America, in a certain sense, even invented. It goes right back to the founder, Alexander Hamilton. It was a conspicuous part of the Lincoln presidency, and then it was a very conspicuous part both of the Republican Herbert Hoover administration and of the Democratic Roosevelt administration, which simply expanded the scale of the Hoover initiatives, because by the time Roosevelt took office, the problem of the Depression was recognizably bigger than it had been immediately realized after the crash of 29. So what we're effectively talking about here is the rediscovery and reinstituting of a great American tradition that has served this country well in the past, even the recent past, and has been adopted by many other countries across the world, all of which have prospered immensely when they have adopted it. And that includes the German economic miracle of the late 19th and early 20th centuries. It includes the Japanese economic miracle of the late 19th and 20th centuries. all of the tiger economies of East Asia, and now, as Ellen, of course, is very eloquent at pointing out, China itself, insofar as it is prospering, it is partly thanks to the adoption of this kind of model. So when they say socialism with Chinese characteristics, they could just as well say socialism with American characteristics.
I think it's a really great idea, and I think its time has come. This is a system that got our country out of sort of major disasters in the past, and we have so many moving parts to what's going on. People are weary and they don't want to be put out of work just to save somebody's stock portfolio along the way, and they want affordable housing and they want roads, and they see what's being done in these other countries and they don't understand why we don't have it. This is why we don't have it. It's the way we're trying to finance, or the way we just ignore problems and go along our merry way following Wall Street and following the politicians that are owned by Wall Street. Thanks so much for tuning in to A View from the Left Side today. If you enjoyed the show, please consider liking this podcast on social media and becoming a subscriber. This is Representative Pam Powers-Hanley signing off. Until next time, please take care of yourself, stay healthy, and stay vigilant.